So we talk all the time here at 10 Capital about making sure you understand your purpose. What are we trying to achieve? What are the trade-offs? What plan will help get you there? And then we finally get around to the portfolio and what specific investments are right for you. How do you make those choices? This week, Brian and I are going to walk through the framework that we use to help make those decisions. So a few weeks ago, Brian and I came to you to share a little bit about our philosophy here at 10 Capital, how we think about investing. This week, we're going to look at our process. There's really two big parts to that. One is asset allocation. What are the different things we want to pull together for clients? And then the second piece is what specific types of investments within those boxes do we want to use, and how do we go about finding them, and when do we know that we want to sell them? So this week, we'll start with asset allocation. Throw it over to Brian.
So when we think about asset allocation, the first piece we want to do is identify different asset classes that we want to be invested, and each asset class has its own unique characteristics that drive returns over time. So we want to own a number of different asset classes that have different drivers for returns. And then the second piece is we want to be cognizant of the fact that there's a relationship between risk and reward. Here, this graph generally depicts as we're taking a lower amount of risk, we would expect returns to be lower. And as we take more risk, we would expect returns to be higher. And we also need to be aware of the fact that these are projected returns and really the likely outcome over a longer period of time. And so as we move from lower risk to higher risk, the range of outcomes is wider.
Question we get a lot is, well, what's good? Or how come we're in this? It stinks. Or why don't we have more of that? It's great. Again, it's all relative to what should that be doing over time, and understanding all these things in a healthy market are not going to be acting the same. And so when you understand where that dotted line, think of that as kind of a long-term average of expectation, something being down below it for a moment in time actually lets us know this might be a thing we would want to move more into, not shy away from. And so that helps you get again into that buy low, sell high, as opposed to what most people do who are just looking at the back of their 401k pamphlet for past performance, which again usually causes people to buy high and inevitably sell low.
This is a graphic that we like to show people because it highlights the benefits of diversification, and also the reality that over the long term, we would expect returns to be commensurate with the amount of risk we're taking. Yet in any given year, certain asset classes are going to be the best and worst performing, and your highest long-term return asset classes aren't always going to be the best return on any given year. And so if we own a diversified group of asset classes, despite any one individual having a good year or bad year, we hope to get more consistent returns in the middle, and therefore maximizing return, yet providing lower risk and lower volatility to the investor.
The dirty secret around diversification is it's going to keep you from being the bottom box, but it's also going to keep you from ever being the top box. So as Brian says, you'll tell people, hey, we want to help smooth out the process. For most people, I think that sounds really good until you have a year like last year where tech is a top box and it's smoking all the other boxes, and everyone's like, well, why can't we just find that? And again, you look at this chart and you may be saying to yourself, well, I don't know which asset classes those boxes represent, or which calendar years are we looking at. The point is, it doesn't matter. There's no discernible pattern here. That's why you can't predict markets or market returns. But what we want to do is, hey, stay somewhere in the middle. Yeah, you're going to have to sacrifice some highs, but you're going to avoid a lot of that lows. And one of the key things to that, again, is lessening that emotional bandwidth that you have around your portfolio that might keep you from doing something especially bad to that portfolio that could impact your long-term goals. Well, we're going to wrap it up there for this week. Again, investing is a very counterintuitive business, so the more information you have about how chaotic things can be in the short run, but again, those long-term averages will help, again, keep you on the right track. The next part of this series, a couple weeks from now, is going to be focusing on, once we know which boxes we want to fill up, how do we go about finding the specific investments? Thanks so much.